All right, so investing in the stock market. Let's cover some basic tips now. Obviously, I've had success investing in the stock market, but I am fairly young, like we talked about in the initial overview lecture, okay? Now, this is stuff that obviously I've learned anecdotally, but even though I'm young and I've still seen success, this is also stuff that I've heard echoed, right? Echoed over and over again. So I have many successful entrepreneur friends, I have many successful friends, and I always ask them and pick their brains about stuff like this, and guess what? They all say the same things. That's how I know it's true. That's how I know it's the path to wealth. You go ask people from Warren Buffett all the way down to people like me, right? They're all going to say the same successful things. It's not complicated. It's very, very simple, and that's what makes it difficult. It is simple. You don't have to worry about it, right? So you want to focus on these things. You want to invest long-term, right? So you're not day trading or speculating. That's a loser's game. Long term, you buy things, blue chip stocks or mutual funds or ETFs that you believe in, right? So blue chip stocks or mutual funds or ETFs that you believe in, you want to check the balance sheet of that company, right? So literally, if you're looking into investing into first thing that pops in my mind is Walmart, right? You want to Google Walmart balance sheet. You want to pull up the Walmart balance sheet, whether that's Yahoo Finance or any other place. You want to look at their short-term cash flow and their long-term cash flow, right? So you want to look at their short-term assets versus their short-term liabilities. You want to look at their short-term or their long-term assets versus their long-term liabilities, and make sure that company has significant positive cash flow. What that's going to do is that's going to ensure that they have the funds and the ability to pivot going forward and make smart moves and smart investments going forward. If they're negative cash flow, that's a major red flag. I personally don't invest in companies like that, although you can speculate on companies like that if you want to, right? So this is a formula that's going to work for everybody. You invest long-term, you invest in something that you believe in, whether it's an ETF or a mutual fund. Obviously, you don't, if you're investing in like an ETF, like, Vanguard funds or something like that, or a mutual fund. What that is it's a combination of stocks. So if you invest in like VU, that's the total stock, or VTI, is the total stock market, right? You're investing in a number of companies in one fund for a low price, okay? So that's basically a mutual fund or an ETF is a compilation of companies, so you're not just buying into one. So it's a lot safer that way, but it doesn't pay as high of a margin over time, right? So it's a little bit less volatile, but it's a lot less, of a sure thing, for lack of a better word, long term, okay? Long term. So if you don't need to look at a balance sheet if you're looking into ETFs and mutual funds, if you're looking into blue chip stocks that you believe in, obviously you want to know a little bit about the company and their direction, but also you want to make sure that they have good significant short-term cash flow and good significant long-term cash flow as well, okay? You also want to do dollar cost averaging, okay? So you can't time the market. A lot of people will say once they get more advanced, like, hey, I'm just going to buy the bottom, right? I'm going to buy the dip. Good luck with that, okay? You might be able to do that once or twice, but eventually you're going to lose out, and you're going to lose out big. That's a loser's game. You can't time the market. You can't time the bottom. What you want to do is you want a dollar cost average, okay? And what that is going to do basically is it's going to reduce the volatility of all your stocks, because you're simply putting money in consistently, okay? So all dollar cost averaging is, if you want to put it in the simplest terms, is not worrying about whether a stock goes up or down, just simply consistently putting money into the stock market every single week or every single month, right? So select something that works for you and your budget. So maybe you come up with something that, hey, you're able to allocate $100 every week to invest into the stock market. You're going to put that in there, and you're going to invest into a blue chip stock or an ETF fund, regardless of whether the market is up or down. I want to repeat that. Regardless, you want to invest consistently, regardless of whether the market is up or down. That is dollar cost averaging, right? So whether the market goes up or down, it does not matter. You put the money in consistently regardless. If the stock market is up, great. Then you should look at it as, hey, your investments are looking up, and obviously the stock market's good, so you're feeling great about that, and you hope it continues to rise, right? If the stock market is down, then great. You just got a bargain, and your investments have more upside. Regardless of whether the stock market is up or down, it does not matter. Dollar cost average, invest consistently. That is how the most successful people in the world do it, and they don't try to time the market because they know that that's a loser's game. Now, I do have free stocks on Robinhood, Webull, and M1 Finance. Those are all three platforms that I use. I invest, so I have my Roth IRA on M1 Finance, and I invest, a little bit on Webull. I didn't used to like Webull because I used it, but I didn't used to like it compared to Robinhood and M1 Finance because it only had an app. They've actually just launched the website version of their brokerage, so I'm a little less, I'm a little more bullish on it now. I'm kind of sold on Webull. I kind of want to try investing on Webull a little bit more now that they have a website version as well. But the main two that I use are Robinhood and M1, and I'm moving a little bit of my money into Webull to see if I like that interface as well. So you can get a free stock on Robinhood if you go through my link attached to this lecture. You can get a free stock on Robinhood, and I believe so. Free stock on Robinhood worth up to $1,000. You can get a free stock on Webull up to, I think, $250, and you can get free $10 on M1 Finance if you sign up through my links. Those are all platforms that I use. How I got into the stock market, it's really just been a passion of mine. I started to invest, made a little bit of money, got a little bit of luck initially before I really knew anything about it, and I was addicted from that point. My experience with it has been very, very good. I've been very, very lucky. But keep in mind, like I said, I dollar cost average, okay? I'm not trying to day trade. I'm not trying to time the market. I'm investing consistently and seeing my portfolio grow consistently, whether the market is up, whether it's down. I still do it every single week. I invest every single week into my Roth IRA. I think 100 and whatever it is. So you can invest $6,000 total per year into your Roth IRA currently. So whatever that comes out to weekly, I want to say it's like $106 out of my bank account. Auto deducts weekly, so that by the time the year is over, I have maxed my Roth IRA, and that's basically a long-term investment strategy, right? It's basically kind of like, for lack of a better way to put it, it's a 401k sort of for entrepreneurs, right? Because I don't have an employer match, I'm an entrepreneur, so I have a Roth IRA. Basically, the difference between a 401k and a Roth IRA is 401k is you're putting money in post-tax, right? So the benefit of that is that you can you can invest your money more before you have taxes, so you can put more money into the market so it can compound more, right? But the drawback of that is that you're going to get taxed when you pull it all out. So you're going to get taxed in one lump sum when you pull all that money out, and that's when you're going to get taxed later. Also, a drawback is that you're not locking in your tax rate now because taxes tend to increase. So you'll be putting in money consistently at different tax rates going forward. So, you might, what I'm trying to say is that your tax rate, while it might be a certain percentage now, it's going to significantly increase in the future, maybe 30, 40 years from now when you pull the money out of your 401k, right? With a Roth IRA, it's the opposite, right? So you're investing your post-tax money. So while you can't invest as much because you're getting taxed on it ahead of time, so you have less money to put into it. So that's a drawback of it. One of the benefits is you're locking in the tax rate now, right? So you're investing post-tax money, so you won't get taxed on it later, and you're locking in your tax rate now, so it won't go up. So two different things. I have a Roth IRA, you might have a 401k, but regardless, obviously, I recommend that you invest. But just to recap on it, you want to invest long-term. You don't want to focus on day trading or speculating on anything. You want to invest in ETFs and mutual funds, obviously. They're balanced, they're safe, and it's going to compound consistently over time. You can also invest in blue chip stocks that you believe in. Excuse me, I'm getting a little bit excited because this stuff, obviously is a passion of mine. But you want to make sure that you believe in the company long-term, and you want to check their balance sheet and look at their cash flow situation, okay? Also, dollar cost average. Don't worry about if the market's up or down. Just consistently put money into the market. That strategy will work for you, I promise. Also, remember, you can get 3 free stocks attached to this lecture to start out, or just add to your profile if you want.